My name is Alejandro Zambrano, and I'm the Global Chief Market Strategist with ATFX, which is a global broker, but also the Chief Editor of InvestingCube.com, which is a good spot if you want to be up to date on what's going on in the markets, and also providing some interesting trading education. One of them being the online trading summit taking place this Saturday. You haven't registered yet, strongly recommend that you do, and that will be able to join live for that event. Look, let's begin. EURUSD. So yesterday, you got some decent data from the U.S. You got some good GDP numbers, got some good durable goods orders. The only thing I think that disappointed a bit was inflation. So core inflation, the PCE inflation gauge, increased by 1.6%, which was lower than the 1.7 prior and the 1.7 projected. As well, what else here? The headline figure, see if I can find this one, increased. Well, actually, the headline figure increased by 1.3% versus 1.2 projected. So overall, I guess a bit mixed on the inflation data. But looking at the actual numbers, core inflation at current levels of 1.6 and headline inflation of 1.3. I mean, it's not a really great numbers. There's really no need for the Federal Reserve to increase interest rates. And I think this is pretty much priced into what the market is expecting. Last time I checked, there was about a 60% likelihood that they were not going to cut rates in June. And in fact, look here. So the current rate is at in the interval 150 to 175 basis points, right? And there's a 57% likelihood that that's going to be the case. The rate's going to remain at that level in the June meeting of 2020. And then if you add the fact that you have 3% of people anticipating rates to increase, you have a 60% likelihood that rates remain unchanged and a 40% likelihood that interest rates are reduced by what looks to be here at least 25 basis points, so one more rate cut. So that the data today sort of kind of, at least the inflation data kind of reinforces that not much is going to happen. And then on the other hand, you have durable goods orders and the GDP number telling us that it's looking okay. We have already seen comments from people like Kaplan, which is part of the Federal Reserve, that they do think that fourth quarter GDP will be soft. And let's take a look at the Atlanta Fed GDP Now model. So the latest forecast is for GDP in the fourth quarter to be 1.7, and obviously we're not done with the fourth quarter yet. We still have December, but from having rather bleak readings in the beginning of the month and not going back up again, and that's pretty much what consensus is anticipating. So it's telling us that U.S. GDP should be okay. And again, probably, unless the numbers coming really strong, it's quite likely that there will not be any major change by the Fed. Now, we do have like inflation figures from the EU. I think they should be out on Friday. So numbers from the EU, I mean, they're worse. You can't see them here because I have more than one screen. But Euro Consumer Price Index is anticipated to rise from 0.7 to 0.3, whilst core inflation is anticipated to rise from 1.1 to 1.2. So again, low inflation figures, but definitely lower than what you're seeing in the US. And we have unemployment figures coming out as well in the Euro area. And unemployment rate is at 7.5 in the Euro area and sort of reached these levels in June 2019. And since then, there hasn't been too much of a change. And I think overall, what it's all telling us, guys, is looking at the numbers here on a relative basis, most likely ECB, more QE, all right? And then you have most likely the Federal Reserve here doing nothing. But if anything, who's gonna make changes first? Probably the Federal Reserve, if they're gonna make any changes. That's what I would say. So overall, if this sluggish trend of a stronger dollar continues, it would not surprise me. Just because you have that slight yield advantage. And it's not just here. You have the Australian Central Bank. They might be ready to cut interest rates. in February most likely. You have as well the Japanese economy. Some people talking that they might head into some sort of recession, and then you have the UK with the general election and a bit of uncertainty here. So overall, there's not too many places you can go to rather than the dollar. So I still think we're gonna be trading lower and lower and lower. And technically, it's sort of telling us the same story. You can see here that the trend is bearish below 111.01. And a few days ago, we said, look to sell here for the market to decline, which it did. And now fib from this high to this low show you that around the 50% level, people are probably going to sell. And they're going to try to push price to the downside. So there's no real change here to the outlook at all. And I think eventually, if we don't go all the way up, we'll spend some time here. But at one point, we'll probably take out this double bottom at 108.89. GBP versus the USD goes up, goes down. In exactly 2 weeks' time, we're gonna have that vote, and in the evening of December 12th, I think voting should usually finish. I think it's don't remember now, but I think it's like 7 p.m. or something like that. Yeah, probably 7, if not 8, maybe. And then you have an exit poll, and then overnight, like probably if we just look back at the other referendums, midnight, 1 a.m., 2 p.m. the results start to trickle in, right? The idea is that you do an exit poll, and from the exit poll, you get an idea who can be have a majority. And overnight, we had a YouGov poll that is predicting a Tory majority, and that lifted the pound a bit because I guess the economy's, I mean, from a business perspective, it might be quite good. We'll see what happens, right? So we all sort of know that in the case of Brexit, it's probably going to take quite a long time before they find better deals around the world. Usually takes about 7 years, typically, some sort of a deal. On the other hand, they said they're not going to cut rates today, but then maybe in the future they're going to cut rates. And if I think if they do want to have a trade deal with the U.S., there's going to be more deregulation, which is quite likely. So from a business perspective, it's balanced. It sort of depends on what happened, but it could potentially be good. What if they do slash corporate taxes to very low levels? What if they do make it easier to hire and fire, and things like that? Then maybe we'll have some more business here, and that could help the pound. So help the corporation. Not sure if it's going to help the people. And that could maybe explain why this goes up. The other explanation is just straightforward, that people are happy that maybe we can leave this behind, because people are delaying decisions, buy a property, set up a business, and so on and so on. So maybe that could be an explanation. So many things, and it's impossible to know what's going on in people's head. We need to remember that. Do you know how the newspapers come up with ideas for their story? I know this because I used to feature quite a lot in Reuters News, and we're very good friends with the guys over there. So what they do, the journalists, they will contact, and it's not just from there, from other places I featured. What the journalists do is that they contact people like myself. They contact, hedge fund managers. They contact brokers. So they contact like five, 6 people. Ask them, what do you think just happened with the pound? And then everybody comes with their explanation and gives their view. And obviously, if you're a hedge fund, they will be saying, oh, actually, I saw that a lot of people were buying because this and this. So what people do is they just tell what they think is moving the market. And then what the journalist does is that, well, if 4 people are saying the same thing, then that's probably the truth. And then that becomes the story that people talk about. But at the end, no one really knows for certain, because there's no obligation for any buyer or sellers to tell why they're buying and selling. It's the same thing on the stock exchanges. You can see which broker bought and sold what on behalf of its clients, but you don't necessarily know exactly why the client bought or sold. You don't have that information, and it wouldn't make sense to always go and ask people, why did you buy today? Why did you sell today? So yeah, it's just very difficult to know what's going to happen next. Technically though, as I've been saying over the last few days, it's not. We're in a nice little sweet rectangle, and we just need to wait for a breakout, either a bullish or a bearish one. Dollar yen, it's looking good. with the US data going up, US stock market going up, this moved up as well. But not everything is very straightforward. And on my Financial Times today, this is a bit, they have updated the page, but this section here, now this is just a headline, but as you might know, that the US has introduced a new law where they're going to review the situation in Hong Kong, and if it's shown that things are not really pro-democracy, or things are not really working out, Hong Kong doesn't have a special status as it's been granted up until 2040 or something like that, then the US could impose sanctions against people in China related to this. And it's a different different way of doing things. It's not that you necessarily do something big, but you do punish the people that are part of it to not, for example, do business with the US, have assets freeze, and so on and so on. And this could potentially cause more tension. And I think that's the reason why, if you look at the S&P 500, it did decline a little bit yesterday. Had that slide around the same time as that was announced. So it dropped at 23 and then 23.05. So that could be something, because the problem here, because of this new law, it could be tensions between US and China, where you can have probably lower likelihood of having a trade deal. What is quite interesting, though, is because the way this is being set up, and what's happening here is that this view in general about what's happening over there is probably supported by Europeans as well in the EU. So we'll see what happens here. It's a bit different when it came down with the trade wars, where the EU was very anti what Trump was trying to do, and then as well, you got the trade wars, Mexico and Canada, and that was also not really sort of being looked at favorable. But this is something that I think a lot of people can unite around, which means that maybe the ability for the Chinese government to act on that might be slightly limited. But at face value, it will create more problems, at least in the short term. So what's going to happen next here then? Well, in the case of the dollar yen, if that story starts to get legs, and we start to see tensions when comments from Chinese official and also comments then by US officials, then and it doesn't look good, and that could be maybe the beginning of a bigger correction potentially, because we know up until now everything has been about, well, trade wars going good, trade wars, we're gonna have a deal, So far we haven't really seen a deal. At the same time, the US data and so on has done better. Realistically, as long as things don't turn really crazy, most likely the US data will continue to do well, and we'll see probably further improvement, at least right now, which will tell me that if we go down to maybe 109 again, I think people are gonna probably try to accumulate here and try to lift the price to 110, maybe 110.40. And that's it. Remember, a few days ago we said look to buy here, book the profits here. This is a very good spot to book profits, unless you're very, very bullish and want to keep half and keep it for another move to the upside. What else? Crude oil prices getting a little bit tired, right? It's moved up strongly, and when prices don't go up for a long time, people said, and especially because Thanksgiving and everything, they're gonna probably take time off, and they're gonna say, okay, I'm gonna take time off, and I'm not going to be holding positions. I guess that's what we're seeing a little bit here. I'm not sure it's going to come down tumbling to 55.83, but probably down and then probably upwards. I'll remain bullish as long as you're about 84.67. Then you have gold prices, which remain bearish below 14.80. I think if we go up to 1469.67, I think people are going to sell, push the price to the downside. We did talk about selling here for it to go down. The alternative as well is to break below the November 11 low, take it out, a bit like the EURUSD. S&P, which we already talked about, is going down a bit. and I think it can go down. And if it goes down to 3,117, I think people are gonna start to accumulate. The last very good setup I shared with you guys was to buy at 3105. So it was here for it to go up. Now we're starting to see some reversal signs, minor reverse. But I can tell you this is not the time to buy. The time to buy is down here, and I will remain bullish above 3,088. German DAX, this is a tricky one, but if you happen to be bearish, you know, it could be used as a contrarian. You can probably short sell here, stops on the other side. For me, right now, this is just neutral within that range. Okay, let's see if you guys have any questions. I think I did forget to load the chat box. So we'll click here and see if you have questions. Okay. Put a good morning here. I should have done that. Guys, what we're gonna do now, we're gonna wrap things up. I think you already started to like the video. That's really cool. If you guys are watching it, there's 6 of you guys. So guys, 3 of you didn't click on that you like the video. Please make sure that you do like the video. As well, a little reminder that on Saturday we're gonna have this event. It's free to join. Click on Learn to Trade Summit 2019. We're not going to do anyone until the next quarter, most likely. If this turns out good, we'll do one maybe February, March, probably March. So if you want to check it out now, then join. Obviously, if it does good, we have a lot of people attending and signing up. We'll try to get some more people in. And, you know, some of these guys are probably new to you guys. Fully understand that. And that's actually quite good. So you don't see the same faces. And that's why I invited all these guys. You don't have to watch me every day. So I invited these guys here, so hopefully they can show you something different. I'm gonna be watching, I'm gonna be moderating everything, I'm gonna speak as well. If you want to know what people are gonna speak about, you scroll to the downside and you can read up here with what they're gonna talk about, and who knows, maybe you can learn a bit more about what to a little bit more about trading. I'm not saying that you don't know, because I'm sure you know, but it's always good to learn maybe a few new strategies, few new ways of thinking about the markets. Okay, we're gonna wrap things up. Guys, have a great day. Okay, so got a question here actually. What's the trend on Aussie dollar CAD? Take a look at Aussie dollar CAD. Just give me a second. Aussie dollar CAD. Okay, this is the Aussie dollar CAD. I remember this one. Okay, in the very short term, BNN. Well, in the short term, there's no trend here. The market is trading within a range effectively since August. When this happens, fortunately, there's not too much to do. It's just trading sideways. There's absolutely nothing we can do or should do. It's traded sideways since August. Who says it's not going to trade sideways for another month or so? If it doesn't break out within the next 2 to 3 weeks, 2 weeks, it will be stuck in a range, because the last 2 weeks of December should be very quiet, as they are historically. Looking beyond near term, this is actually a big and massive rectangle. I remember this one because I think I traded some of this section here. And this is a massive rectangle, which does suggest that the Canadian dollar could gain with 13.77%, because we breached this range. And you might also say, well, what's going to cause the Australian dollar to go down so much then? It's not so difficult to figure out. The Australian economy is very closely linked with the Chinese economy. So this could be something if trade wars don't resolve themselves. And also what's quite interesting is that because we're in this little tiny range, it can actually work as an opportunity to launch this bigger pattern. Because what happened here, by the way, is that the market went down, spent some time, and then down, and I guess not a lot of people wanted to short immediately on this break. But this is actually not that bad, because when and if, especially if we trade below something like 88.33, say we trade below 88, I'm not sure what's going to happen on the day because it's not time yet, but it might be a situation where we might be able to sell, maybe put 145 pip stop loss, And if we will go down, you're looking at 6.73 risk reward ratio. So this is definitely something to keep an eye on over the next few weeks and months. The issue here is that I don't know if it's gonna go up or down. Get a Paul Owen, how you doing? Good to see you again. EU consumer confidence, final actual minus 3.7, forecast minus 3.7, previous. Okay, yeah, 10 a.m. Yes. Yeah, so we have some of this data out, but I don't really think it matters too much. Let me see. You have the business climate one as well. What can I say about the data overall then? This data coming out from the EU. Well, let me see here. So the business consumer confidence. There's so many. There's 4 of them. So it looks like the data from business climate was slightly lower than expected. You have as well industrial confidence slightly lower than expected. And then you have the Eurozone economic sentiment indicator, which is slightly better than expected. Overall, this data is not really relevant for the market. It's nothing really that it pays attention to too much. It's quite interesting how some of the data is useful for macroeconomic forecasting. There is one economic sentiment, I think it's the EU economic sentiment or the EU business climate, which is derived by the European Commission. I'm not sure if it's the same one here. It is actually the same one. And what it does is that one is quite useful for predicting Eurozone GDP growth. But not all economic data is something that traders focus on. So some of these data, you can again use it to get an idea. So you can, for example, use it to figure out, okay, the unemployment rate, which I talked about, and maybe the inflation rate, where is that going to be in the next few months? Some of this data can be used for that. But, and you can have like a very long-term view. But what because I used to do quite a lot of this before, what I remember is that you can do all this analysis and then you had an idea of if the ECB would be hawkish or dovish, and you can take some position on ahead of the ECB rate meeting. So if you have all your models and you think actually the ECB is going to be quite hawkish now because they think my models are telling me the economy is going to go up and inflation is going to go up, and then you can make some decision. But there is a situation here where there is very little change on the back of Eurozone data until the ECB acts. On the other hand, when it comes to US data, it's actually tends to be influenced more by investors. So the ISM indicator, which is something people focus on, also like different liquidity measurements, which is also something people focus on. People are happy to take a position on way before the Federal Reserve acts. In fact, many times when the Federal Reserve acts, when it comes down to these calculations, they're usually spot on, or not spot on, but they're usually there. Oh, sorry, I'm losing track of things now. When it's time for a cut or increase, it's usually already priced in. So, whereas you don't necessarily have the same. And that's a tricky with macroeconomic forecasting. Like if technical analysis is hard, but macroeconomic forecasting is even harder because you can do all your different models that project where the economy is going to be, right, or where the economy is going to be, but you don't necessarily know how, if the central bank, if the traders are going to focus on the same data sets that you focus on. So, for example, again, I think it's the business climate. I do think, if I remember correctly, it's this one here that has a high correlation with GDP. But as you can see now, people don't necessarily care or trade on the back of that. It's barely changed, right? So that's the tricky part. So the question is, when will the indication here be strong enough? And what people do sometimes, let me explain as well. It's quite fun actually. So for example, this is just to give you an idea, right? The different, it's not very straightforward, but on a relative basis, it's all about relative strength. So if this indicator starts to tell us, well, the economy in the euro area is going to gain a lot, then we can start to take position. So, for example, you have GDP growth, which, you know, maybe 2%, 1%, maybe recession, and then it sort of looks something like this, right? And the problem with quarterly data or GDP data that is quarterly, so it's just shared every quarter. So we just got number stuff from the US, for example, for the third quarter. But hey, we're 2 months into the new quarter, right? And it's going to probably be until January something when we get data for the fourth quarter. So that's when people start to use these different indicators. And then these little different indicators sort of predict, oh yeah, the economy is going to go up. And that's what, when the indicator itself is suggesting, oh, we should be actually up here. And then other economists maybe project that, well, GDP should be here, and you have that little gap. Then you have a trade idea, because you can say, well, we want to buy euros because the market is underestimating the strength of the euro area. And then they will do this analysis like that. The problem is this though, that model needs to be right. So when the actual GDP numbers come, they need to show the fact that we went up. Obviously, if it does go up, then there's not going to be any change. So what people do, they take positions before that happens. But the problem is you don't know if other people are looking at your numbers right now the same way you're looking at them, and it can be very long lead time. But to give you an idea, the ISM, the way the stock market is now, it actually, I saw a chart on this, it implies that the ISM indicator, which last time I checked was around 52, last reading was 48.3. But the way stock markets have risen now, they're projecting that the US economy, or the ISM, I think is going to be at 58. So if the numbers in the US do not improve, then there's going to be a gap. And this is an opportunity for someone very clever that thinks that, well, the economy is not going to play out. Then you can buy some puts in the stock markets, and then probably expiry in the first quarter or something like that, and then see if you can actually trade that. So the question is, what should a retail investor like ourselves, people that don't have a PhD in economics, or more importantly, doesn't have time and all the data, because to buy all the data, you know, costs quite a lot of money. Then you need to process everything, which is even more time consuming. So what can we do? Well, fortunately, there's not too much we can do, but we can remember this. Macroeconomic trends change really slowly most of the time. They, like the situation here, you know, will the US economy continue to outperform the European economy? Yeah, most likely, right? You have that technical chart here as well, suggesting the same. So those changes and shifts don't happen very quickly. So when they shift from one theme to another, you get stuck. So we've been stuck in this downtrend here since, well, this sluggish downtrend since May of last year, but effectively since February last year, or 2 years ago. No, yeah. In February next year is going to be 2 full years, right? And that's what we can do. So we don't necessarily try to forecast too much of what's going to happen. Obviously, we want to keep an eye on the economy to try to maybe pinpoint these massive moves to get an idea, but otherwise, we just go with the flow. For example, I have and Anders pitchfork for the Euro USD. If you draw it like that, you can see it has done quite a good job explaining what has happened here in the Euro USD over the last year or so. And since because I haven't always been using pitchforks, but I think I picked it up here in August sometime, and since then, in what we would be calling a forward test, because I haven't changed it, it predicted this move, this, and this, and this, and it still projects that we're gonna trade lower. And you can keep an eye on sort of what's gonna happen. Maybe it will break if the Federal Reserve or the ECB would make any major changes, but I don't think they will do. I have similar stuff. This is the Aussie dollar. This is a trade idea I shared with my clients, and the idea was to sell here because this is what the pitchfork was saying, and so far it's looking good. Residual ratio 3.37 now, and it's going in the right direction. So that's what we can do. We don't have to complicate it too much. Look at the bigger picture, be aware of what's happening, and try to figure out, will this change over the next few months? If it's not going to change in the next few months, just go with the flow. What's also quite interesting, especially if you look at the dollar index, this channel as well has been very, very good. When we're up at the channel, everybody's going to tell you king dollar, and the dollar is so good, so and so on. And then when we go down, everybody tells you, oh, the dollar is going to collapse. But the way this market is structured right now and the way these channels are laid out, it pays off to be a contrarian. Okay, guys, we're gonna wrap things up. Thanks for joining. Don't forget to hit that like button. It's still just 5 likes, so please don't forget to like the video. As well, don't forget to check out our homepage on investingcube.com. We do also have an Investing Cube channel. So we have our own YouTube channel, which is this one. And we're gonna be uploading a bit of different content here. So please subscribe to that channel. So some of you guys have seen it, but we produce some of these videos on their short-term videos, so it's going to be a bit of a different content here, but yeah, you can check this out and subscribe to us. We'll see how it goes. If people like the stuff, we'll do more of them. Okay, guys, thanks so much for watching, and catch me tomorrow same time here on the ATFX YouTube channel, and as well on Twitter and investingcube.com. Have a great day. Thank you, and bye bye. Cheers.